Hi, good morning, ladies and gentlemen, or good afternoon, depending where you're based. And thank you for joining us for our webinar entitled Where Are High Yield Bonds Now? My name is Will Clark. I'm the International Partnership Manager for the UK and US markets at Cbonds. And I will be moderating today's event alongside my colleague, Lana Veselova. So, as well as being a financial data provider, Cbonds is also a conferencing house. Traditionally, we've held events all over the world, bringing together industry professionals and private investors. And this year, we've had to switch our events to an online format because of the current situation. So today's event will be split into two sections. First of all, we will have a macroeconomic overview from our partners at Fitch Ratings. And following that, Juliano Torii of Sarria will summarize the latest thinking and research on high yield bond investing. At the end of this section, we'll have a brief discussion where you'll be invited to pose your questions to the speakers using the question and answer section in Zoom. And I will moderate the questions, bearing in mind that Brian will be leaving us early today. Following this section, my colleague Lana will go in to introduce our presentations from Bank Vontobel and Trafalgar Investimentos, where we will discuss the most interesting high-yield investment ideas and possible ways to find the best opportunities in the current climate. So without further ado, I would like to introduce Brian Coulton from Fitch Ratings. Brian rejoined Fitch Ratings in October 2015 as Chief Economist. Previously, he's worked at Legal & General Investment in London, and prior to that, Brian worked for 11 years in the Sovereign Group at Fitch Ratings, including spells in Hong Kong as head of Asia Pacific Sovereigns. He was also formerly an economic advisor at Her Majesty's Treasury. So Brian, over to you.
Thanks very much, Will, and thanks to everybody for dialing in. I just want to give you an overview of how we're seeing macroeconomic conditions at the moment as a backdrop to the discussion about high yields. Yeah, this crisis has been of an intensity and a violence from a macro perspective that we've hardly ever seen before. Certainly not in my experience as an economist. And yet, despite the fact that we are no less than 9 months into the crisis, it clearly is still not over. And in some ways, I think it's fair to say that in many ways, the hard part is yet to come. It may seem like a strange thing to say, given how tough things are, but I do think in many ways we have got the hardest part of the crisis ahead of us. And the reason I say that is because a lot of the economic adjustments that you would have expected to happen have in many ways been suspended, partly through government intervention, through support, through decisions of lenders, through decisions of companies. And the longer the crisis goes on for, I think the more those adjustments will become inevitable. And I think this will be a key theme as we go into 2021. Many of the adjustments that we would expect to see with an economic shock of this magnitude so far been suspended are going to come home to roost, I think, in the next 12 to 18 months. So I just want to put that out there as a sort of theme before I get into the specifics of how we're seeing the world. So first of all, let's just go back to the shock that we've been through, because it is important to understand the starting point in order to work out where we are at the moment. It really has been a very a tumultuous period for economic activity. Huge dislocations in global activity. We think the global GDP declined by 10 percentage points between the end of 2019 and the middle of 2020. That's outside the range of almost any sort of stress test that anybody was doing, certainly in terms of global GDP numbers anyway. And the adjustments have been right across the board: rich countries, poor countries, large countries, small countries, all regions of the world. Nowhere to hide, really. Emerging markets versus developed markets, it's not made any difference. The sorts of adjustments that we saw in the second quarter, yet there were important differences. We saw countries that had more stringent and longer lasting lockdowns in the second quarter suffered the largest adjustments in GDP terms. But the broader picture really is that there was absolutely nowhere to hide. The breadth and coincidence of these adjustments happening everywhere at the same time was really totally unprecedented. And in many ways, I think this will be another key feature as we go into 2021. We are going to see more differentiation across different regions of the world, across different economies, as we move into next year. But when we're looking back at where the economy has just been over the last 6 to 9 months, it really was staggering in how coincident the huge shocks to GDP were. But while the shocks were enormous, the adjustment was also in many ways unbelievably short. Essentially, it was a 2-month recession that we saw in the major economies in March and April, as lockdowns were imposed and economies were sent into these confinement stages. We saw these precipitous declines through March and April in economic activity. But then things bottomed out in May, and they started to improve again by June. So I think an interesting statistic here, which I may have shared with you on one of these earlier calls, is that we see in some G7 countries, we have seen decline in GDP from where things were before the pandemic in January, of 25 to 30%. We think France, for instance, saw a decline of 30% in GDP between January and April. That 30% number, UK, as you can see from this chart, was 25%. In the entire course of the US Great Depression, real GDP in the US only went down by 30%. So we had a recession as deep as the Great Depression, and it all happened in a couple of months. So this it was really outside the range of anything we'd ever modeled before. But the bounce back has been quick, as you can see, particularly on the consumer spending side. Retail sales got back to their pre-virus levels fairly quickly by the late summer, and what we've been seeing up until about the last month anyway has been a string of pretty decent numbers in terms of sequential growth. And let me just share with you now how we were looking at the world economy as of our early September forecasts. We make these forecasts on a quarterly basis. Usually, we were doing it much more frequently back in the spring and the summer. In September, we decided to revert to a quarterly frequency. So our last published forecasts were made the first week of September, and as of then, as you can see, the decline that we had in world GDP was about 4.5%. Twice as deep as the recession that we saw after the global financial crisis in 2008. So an enormous shock to the world economy, but one that was expected to be relatively short-lived and would see a pretty rapid bounce back in 2021, at least in terms of economic growth rates. Obviously, if an economy shrinks by 10% and then grows by 10%, it doesn't get back to where it started. And in many ways, that's been one of the messages that we've been giving to our credit analysts and investors. You shouldn't be looking at year-on-year growth rates and getting too excited about the speed of bounce back. But we had a positive 5.2 for 2021, largely a base effect coming off such a low level of activity in 2020. That allowed a strong sequential improvement next year. However, what we have been emphasizing more is the path of the level of GDP. And as you can see from this slide here, the path of the level of GDP that we were expecting in our September Global Economic Outlook forecasts was very much one that we described not as a V-shaped recovery, not as an L-shaped recovery, but a swoosh-shaped recovery. What we envisaged back then was that for the Eurozone, GDP would not return to its pre-virus level, defined as the Q4 2019 level of GDP. That wouldn't happen until the end of 2022. So as you can see, a two-quarter downturn followed by a very, very slow return back to where things began. So as you can see, very much not a V-shaped expectation that was made in early September. The US, that would happen slightly quicker as of September. Our September forecast, that would happen by the end of next year, but a much slower return to where we started than the very sharp, intense downturn. So how have things panned out relative to those expectations made in September? Well, we were actually very much surprised on the positive side by the numbers that came out last week in terms of the rebound in GDP. In the US, the rebound in GDP was about 7.5%. We'd expected to be about 5.5%. But in the Eurozone, the economy recovered by nearly 13% on a quarter-on-quarter basis, twice as fast as we expected. So it did look a lot more V-shaped than we had anticipated, particularly in France, where we had almost 18% expansion, but also Italy and Spain, very, very strong, very strong recoveries, such that by the third quarter, GDP in the Eurozone was only 4% below where it started in the fourth quarter of 2019. So we've been surprised on the positive side. Nevertheless, I think we're sticking with our view that there is still going to be a tough path of expansion ahead. I don't think these numbers really change the broader dynamic that we're expecting. We still see private sector demand is going to be very much challenged, and this is even before taking into account the recent deterioration in the health situation. Obviously, I'll come on to that, but let's just explore some of these broader themes. Talked about adjustments being suspended, and one way in which this has happened in Europe has been through these massive furlough schemes in the job market, which have recently been extended, and these have prevented so far anything like a significant increase in unemployment. A huge contrast with the US, for instance, where these furlough schemes there wasn't a furlough scheme. So we think this is an adjustment that lies ahead of us in Europe. We think unemployment rates are going to rise. We think that's going to weigh very heavily on consumer spending and on private sector demand. We also think, having been through such a big shock, companies are not really going to be in a position where they have a very strong appetite to engage in capex spending. I think capex and consumer spending are going to be pretty weak over the next 18 months. And then there's the sort of direct impact of the changes in behaviour and the restrictions down to the social distancing behaviour that's become necessary. And I think the best way to think about this is from a sectoral perspective. When we think about social distancing and its macroeconomic impact, we've kind of honed in on the sectors of the economy which are clearly going to be impacted on a very sustained basis by this, which is we've described as the leisure and transport sector. So accommodation and food services, so restaurants and bars, hotels, transport and storage. This includes tourism, air travel, the cultural sector, and as you can see from the right-hand slide here, these sectors account varyingly somewhere between 7% to 14% of GDP, particularly high in Spain, particularly high in a number of emerging markets with a large tourism sector. As you can also see on the left-hand slide, where we have monthly data for these different sectors for the UK, this sector hit much harder, down 60% relative to norms in April, and has recovered much more slowly. And even before the recent deterioration in virus cases, we were not expecting this sector to come back at all. We're expecting well, not saying not at all, but we're expecting it to come back much more slowly than other sectors of the economy, because of the ongoing social distancing behaviour and the ongoing restrictions that we expected to see even before the recent deterioration. So, a number of reasons why we were pretty pessimistic on the outlook for private sector demand, but of course we had to weigh that against what has been an absolutely unprecedented degree of macroeconomic policy support. So as you can see from this slide, we estimate that as of the middle of this year, we had new discretionary fiscal easing at the global level of something like 8% of GDP. Much bigger than we saw in the global financial crisis. On top of that, we had a rollout of huge liquidity and credit programs backed by government guarantees, which played a very important part in protecting the private sector and adding directly to domestic demand through high government spending and through limiting the adjustments to household income. We've actually seen some pretty strong improvements in household income over the second quarter, as, for instance, benefit checks were sent out in the US, stimulus checks were sent out, a big increase in disposable income for households thanks to these enormous fiscal measures. So this was very important in cushioning the blow, and will be important in supporting growth going forward, given that backdrop of weak private sector demand for the reasons that I've explained. On top of that, of course, we had a response from central banks, which again was completely outside the range of any sort of experience, much more aggressive than was seen after the Lehman's crisis. The Fed increased its balance sheet from just under 4 trillion to 7 trillion in a matter of weeks. The ECB announced a pandemic emergency purchase program that was bigger than anybody was expecting before the announcement came. And we think central banks will remain very much prepared to do more. And I'll come back to this as we talk about the most recent developments. And this central bank liquidity response has been very important for market conditions. After this initial tightening of emerging markets credit conditions, we saw spreads coming back down very quickly, and such that I think it's fair to say central banks have been successful in avoiding so far the sort of tightening in credit availability and credit conditions that you would normally associate with a large a recession as deep and large as that as was seen in the second quarter. So that policy response, a very important part of that sort of swoosh-shaped recovery that we had been expecting. But now comes the tricky part, and I'm going to start on a positive here, which is looking at China and seeing, China is one of the few economies that clearly has managed to normalize pretty quickly. They've regained the pre-virus levels of GDP. They've regained a growth rate of 5% year on year. We've seen this broadening out, this recovery in China from industrial production investment initially. It's now also including the consumer. But this is a good story. China matters a huge amount for the world economy, obviously, and for Asia and for emerging markets. This is a very positive aspect of the current story. But of course, what it also says to me is that it just underlines the importance of dealing with the virus in order to get a full normalization of economic activity. And clearly, we cannot say that that's the case in the US or in Europe, particularly in Europe, where the recent virus cases have risen very sharply. And as you can see, we're in a situation now, this has emerged over the last week or so, where it's clear that at the current rate of expansion in new cases, governments are now starting to get very worried again about health systems becoming overwhelmed in the course of the next couple of months. And as a result, they are reimposing restrictions. Now, even before the announcements last week in France and Germany and the UK at the weekend, even before those announcements, we were starting to see high frequency data on visits to retail and recreation venues starting to deteriorate across Europe. This wasn't happening in the US despite the rise in virus cases, but in Europe we were seeing in the UK, in France, Spain, also Italy, don't have it on this chart here, but visits to retail recreation venues were starting to move down again as restrictions were tightened and as people became more worried about the virus. We expect this mobility data which was a very good lead indicator of what actually happened in the second quarter, is going to take a significant further leg down, particularly in France and the UK in the next few weeks. And our view now would be that as the stringent nationwide lockdowns that have been announced in France and the UK take place, this will lead to renewed falls in GDP in Europe in the fourth quarter of the year. Now, we don't think those falls will be as large as what was seen in the second quarter, but they will be pretty sizable. I don't think a 4 or 5% decline quarter on quarter in GDP is out of the question at all in France and the UK. Now, for France, because we're starting with a stronger position in the third quarter, it won't necessarily mean that the annual numbers for 2020 are much worse than we had in our September GEO. We had a 10.5% decline in French GDP. That probably still looks okay, but it will mean that growth in 2021 will be lower than we were previously expecting. Previously expecting something around 5.5. Those numbers will need to come down. We're still working on this. We don't have new figures for you here, but clearly we are heading for a double dip in Europe. I think that's pretty much the central case scenario now, and a lot will depend on how long these lockdowns last for. I think it's a pretty reasonable assumption that we will see a less intensive compression of GDP in the fourth quarter than we saw back in the second quarter. Schools are remaining open. Construction, manufacturing is not being closed down in France in the way that it was in March and April. Also, we're coming from a lower starting point of economic activity. We're all much more used to the pandemic situation now. We've worked out how to carry on spending, how to carry on working. It was a complete and utter shock came out of the blue in late March. So I don't think the shock is going to be so intense on a daily basis. So if it only lasts the 4 weeks which have been announced in France and the UK, maybe the numbers aren't quite so bad in terms of the adjustment in Q4. We would see a quick rebound in Q1, but I think there's a very good chance that these lockdowns may have to last longer than the 4 weeks that have been announced, and then we could be looking at sustained weakness through the first quarter as well. But you have to remember also that the lesson that we learned from the Q3 data that came out last week is that once the lockdowns end, you will get a significant pick up in activity. In a way, the pre-pandemic level of GDP has proven to be a stronger magnet for where economies go post-lockdown than we had previously estimated. So at some point in early 2021, when these lockdowns are eased, or even late 2020, if that happens, you will see economies jump again. I would also say that the global backdrop for Europe is probably looking a little bit better now than it did back in the spring when everywhere was looking very, very weak. China's stronger, as I mentioned. The US at this point still looks like it's going to see a further expansion in Q4. Likely to see more fiscal stimulus in the US. Not too concerned about our US growth outlook. So I think the global backdrop is also slightly better. We will see more stimulus. We're going to have more action from the ECB and the Bank of England, and quite possibly more fiscal stimulus as this growth shock becomes more apparent. But clearly, this crisis is not over. We are due for a second leg down. The sorts of numbers I've been talking about prior to March, again, will be seen as an enormous shock. But it's going to be a long haul back to normality. And I'll just leave you with this slide, which comes from our September GEO, but doesn't really factor in the very recent deterioration in the virus situation. But essentially, our judgment even back then was that we would not manage to get back onto the pre-virus trend, even in the medium term. There would be permanent loss of GDP from this crisis. And obviously, the deeper, the double dip recession that we're seeing ahead of us in Europe is going to make this sort of scarring impact that we're already anticipating that much worse. So I'm afraid it's a fairly sobering conclusion from me on the macro outlook. I'll stop there and see if there are any questions.
So thank you very much for that, Brian. That was absolutely wonderful. Are you going to be able to hang around while Juliano gives the speech, or would you like to see if we have any questions from the audience now?
It's entirely up to you. I'm free until 4 p.m. I can.
Fantastic. So if we just shoot ahead with Juliano, and at the end of that, we'll have a short So maybe a 10-minute quick question and answer session with you still there. We're all aware that you do have to get away at 4 o'clock. So thank you so much for that wonderful and fascinating presentation. I'd like to sort of introduce us now to Juliano. So I'll hand over now to Juliano Torii. He's a senior investment analyst with Sarria. So Juliano has over 10 years experience in high yield, stressed, distressed, and restructuring situations in Europe, the US, and emerging markets. His experience includes all levels of the capital structure, from bonds to loans, CDS, and convertibles. So before joining Sarria, Juliano was a senior analyst for high yield and distressed at Nordea Asset Management. So over to you, Juliano.
So the discussion here today is high yield under COVID. And the first slides, I hope you guys can see that, is a summary of the discussion today and what has happened. And just to go briefly over that, the initial impact was basically very undifferentiated. I suspect that there was a lot of forced selling, a lot of redemptions. People actually did not discriminate that much as one would expect between different sectors, credits. And after that, during the, let's say, May-June period, there was a major change in a major recovery, which is effectively what that meant was that it did, most of it came back almost all the way, and in some cases even all the way. However, the differentiation set afterwards, as it became clear that not all sectors could be saved. As September start flattening, and then people start differentiating again. The fear of missing out start going out of the market. During the initial period, I think that there was, as I said, less differentiation, and people always fight the new war as the old war. So people are fighting Second World War here, like the First World War. And in this case, construction, shipping, some cyclical manufacturing, sectors that were relatively toxic during the last major crisis in 2008, 2009, and 12. They were also very punished, but people start realizing that this crisis was different back in July, August, and therefore, they start picking up those sectors again. And at the same time, a lot of those sectors that used to be safe, they were the most severely impacted this time around. The sector exposure going forward is going to be key because this new regime of company and sector differentiation is become more evident even in the most recent weakness of the past week. And at the same time, underlying that, as we have seen this year and even in previous cases, credit again has proved to be one of the few segments of the financial markets where active management has a strong track record versus passive. And finally, another lesson that you have here is that in credit, as we have seen in the past, being excessively bearish a certain company or a sector, it is as dangerous as being excessively bullish sector, because a lot of people in the sector are forced buyers. So if you're not buying something that is going to come back, you're potentially probably buying something that is not. And one example that I really like is when people were selling the Telefónica bonds at 7% yield in the peak of the Eurozone crisis, while buying the OI, which is a Brazilian telecom operator, bond at around 3 to 4% yield. Of course, we know that what happened with OI after that, and we know as well what happened with Telefónica after that. And the opportunities remain significant going forward. So one example to illustrate this entire trend here in my slides are the construction versus travel. Let's say LatAm is construction equipment rental, and Europecard is mainly car rental. Initially, as you can see, they were thought, those sectors are equally toxic. Let's sell both. They are both rental, see you next year. But ultimately, the underlying driver of the sectors for LatAm is construction, is not so much rental. And the Europe card is not so much rental, is actually travel, is business travel, is tourism. And ultimately, the sectors ended up diverging a lot after the initial synchronized pickup period went away. So the next example that we have that as well, another example of differentiation is shipping versus oil services. Now that's not always very intuitive, right? But if actually, when you're talking about oil and oil services, oil is effectively travel and transportation and tourism. They also have a component in which they are linked to commodity production, but a lot of that was that. And shipping is actually goods. It is the physical supply chain. And what we have seen, looking at Vallourec, which is a heavily oil services business versus CMA, which is also shipping, is that the initial impact was very similar. But after that, when people start realizing that there is a major divergence of the goods and manufacturing part of let's say the economy versus the services, especially personal services or entertainment services and travel and tourism, as the previous speaker has shown. Basically, they have diverged, and in fact, CMA recently managed to refinance some of their bonds, while Vallourec, as you know, is going through a hard restructuring right now. And the third major element of differentiation in this market is liquidity runway. And here I have two examples of sectors that, in fact, before the crisis, WFS was actually considered the toxic one, because they have a lot of air cargo, which in a traditional recession is much more volatile than ground handling, which is basically linked to passengers. People in a traditional recession don't stop flying overnight. So the initial impact, again, very similar in the first, let's say, 2 months. And after that, people understand that WFS is a highly cyclical, also has some linkage to the air passengers as well, but is mostly air cargo, which has done much better because of the goods and manufacturing has done much better than travel and tourism and transportation in general. At the same time, the forced buyers, they congregate on the stuff that has more cash, right? And WFS, as much as people can see that it is a company that's still struggling, they do have plenty of cash. While basically AGNA, as a lot of us know, it was owned by a very distressed Chinese conglomerate, which, not coincidentally is a lot of travel and tourism themselves, which were extracting a lot of cash from Swissport for several years. And bondholders were very forgiving because of the underlying, perceived resiliency of the business before the crisis. And as a result of this, we can see what happens when, even if you have a business that's in difficulty, just having that liquidity runway, that bit more time to actually work things out can be worth 20, 30 points, 40 points in between the different bonds here. And I just wanted to show, of course, secondary in high yield is always only half the picture, because or high yield is an over-the-counter market, so people cannot always express their bearish and bullish views in secondary market. But the primary also shows a similar trend. Just to show here, Adient, being a car seat manufacturer, also a similar impact in the beginning of the crisis. You can see that the coupon that they issued back in April was not that massively different. And autos was the toxic sector even in 2019. If we were talking about a weak problematic sector in 19, autos was it, as you guys might remember. And entertainment was good. Everyone wanted to buy, let's say, experiences, and that was a great experience here, because as you guys can see, they have diverged people that bought into a primary here, thinking that primary should be okay, someone else had done the job for you. Unfortunately, that didn't work so much here. And I want to, I guess, leave with two other messages, which I think are good for most of us here, which work in mostly active or research or investment, is that unlike equity and a lot of the other segments out there, active credit management has a good track record of actually adding value versus the passive approach. And in fact, the money has followed, and the factors is pretty much known for most of us here as liquidity, positioning. Many investors are forced buyers. They're not motivated by profit. They are central banks. They are insurance companies that need practical cash somewhere. So ultimately, not necessarily buying for the value. It is a different asymmetry of payoffs versus many of the other instruments, which have a more asymmetrical profile, and so on. And just to illustrate that, going further, is that Vanguard, which is the big, let's say, Godzilla of equity passive, they actually try to create a active, a fund, which unfortunately they had to shut down because of their own issues over the fund. But even Vanguard tried to create a active credit fund very recently. And the next and final slides that I want to leave you guys with, so I can put a bit shorter for a question for both of us, is new credit special situations well positioned to take advantage at this point. And it's well documented that the best years of special sits, and that's going to be very positive for many of you, are usually for the vintage during the crisis and just after the crisis. And most of this money has been driven by smaller startup funds or small funds in general, because as we know, and especially this year has been the case that this year the larger funds have severely underperformed because they are just too big. The bigger fund has become, the more they look like a big dinosaur, and the less they look like the quick, let's say, Viet Cong, predators that they're supposed to be. And on that note, as just on my firm, we have several years of successful work between ourselves, and I'm going to leave you on that and open to Q&A for either us, for myself, or Colson before me. Thank you very much.
So thank you very much indeed, Juliano. I hope you can all hear me okay. So now obviously we're going to enter into the question and answer section. So everyone, please do keep the questions coming. I've got a very topical one that I'd like to start the discussion with today, which is from Andrew Auslander. And we're going to direct this at Brian. While you're still with us, Brian, very topical today. What is your outlook for the US economy if Biden wins? And what is your outlook for the US economy if Trump wins? And when you've given some feedback on this, obviously, if Juliano has something to add, we'd be more than happy to do that. But what do you think, Brian, about what's happening today?
Topical question, and it may seem strange that I didn't have it in my presentation, but at the end of the day, I'm not sure it makes a massive difference to the macro outlook in the near term. I think it's more of a medium-term question, and so if we think about those sort of medium-term issues, I think the big differences between the two candidates are relate to the approach to the sort of global trading environment, multilateral versus unilateral measures there, on the environment, and on taxation. I think those are probably three of the biggest differences in terms of the medium-term economic outlook. Biden's clearly prepared to raise taxes on higher income individuals and on corporates, so that that could have a significant market and macro impact. I think Biden would be a lot more multilateral in his approach to trade issues and WTO. I don't think US-China tensions ease dramatically under Biden necessarily. they could deteriorate quite dramatically under a Trump second term. But I don't think US-China suddenly goes away as an issue that markets will focus on. I think that's more of a structural change. And then I think on the environmental side, that will be a big issue. But again, more sectors and more of a medium term. Bringing it more to the short term, I think the issues are what would be the approach to stimulus in the next 12 months under Biden versus Trump, and frankly, how might the approach to the pandemic change? So on the stimulus side, I think there's generally a consensus that we'll probably see more expansionary measures under Biden in the next 12 months. I think we'll get more measures either way. Maybe not straight away after, depending on the makeup, but certainly if we were to get a blue wave, I think we would be looking at more a bigger expansion. Infrastructure in particular is something that I think both sides are keen on, but I think more likely to get some significant movement on that if Biden was to win and the Democrats were to take control of the Senate. So I suppose that might be something that could feed through to stronger economic growth. But this pandemic and the responses to it, in many ways, are so much more powerful than any other forces that just a lot will depend on what happens on the virus front, and a lot will depend on what happens in terms of how the policy response to the virus evolves. I mean, one of the things that has surprised me very much through this crisis is how there's been a sort of political divide in the response to the pandemic. It seems we have the right-wing approach is not to shut the economy down and to be sort of libertarian about it, keep the economy going. That's the high priority. Whereas the sort of left-wing approach is to be to be more sort of interventionist and close economies down. That's a very bizarre distinction to me. I can't understand why the debate's gone that way, but it has gone that way. So if that debate is right, it's possible that Biden may want to be more interventionist. Now that could mean a bigger negative shock to the economy in the short term if it were to happen, but very hard to predict that. But I think these virus dynamics and the sort of lockdown restriction responses could be much more important for the economy in the near term than these other differences, I think, and very very hard to really predict that.
Wonderful, thank you, Brian. I'll just ask now for Juliano. Perhaps you have any other comments to add to the US election question at this point? Anything that you might like to add to Brian's comments here, Juliano?
No, I think that it is a very fair assessment.
Wonderful. So my next question, again, quite topical, just given the fact that we are now meeting via Zoom, that we're not meeting now in person, we're not doing a big conference in London, but we're all meeting from all over the world on Zoom. The question that I've got given by one member of the audience is, how is technology going to affect the investment period from 2021 through till 2025? What will you say about that? First off, Juliano, how will technology affect the investment period?
Well, I think that technology has a significant impact on certain specific sectors. Of course, retail, brick and mortar is very well known. Other sectors that are not as clear is car manufacturing as well. But then, sometimes these things are fully priced. Autos hasn't done so badly this year because everyone freaked out about autos last year, right? So, among other reasons, right? And other sectors that could have an impact is oil services as well. As we know, it is shifting away from U.S. shale, has the struggle of the technology basically is plateauing, so they cannot improve like that. But I used to cover the tech sector, many years ago at Societe Generale, and I would say that the tech sector, they tend to have usually the clearest impact. It tends to be on a 3 to 4 years horizon. So if you have like a 3 to 4 year bonds, is usually not something that you're exactly worried about. But if you have a 10-year bond, then and one example that I just want to leave before I leave to the next speaker, I don't want to take all the time here, is SES. I used to be one of the safest havens there was, in the satellite sector. But then the entire video compression technology came in, the new satellite, with much more capacity than the older ones came in. And that sector, as you guys know, got crushed. If you look at Intelsat, Inmarsat, that sector went from safe haven to a complete dog. So it is important for someone for a credit investor as well, to make sure he's not sitting on a safe haven just when it's about to turn into a complete dog. Let's say if you have a Nokia A- bond as well, right? Now that you're in the discussion.
Yeah, not too much, but I think this is more of a sort of sectoral play story than a macro one. But I think the backdrop, sort of the economic context here, is that what we're going through now, and I think this isn't something that all gets reversed, is an acceleration of sort of structural changes in economies on a pace that none of us have ever seen before. I mean, normally these sorts of, the shift to online from offline retail, these are gradual changes incrementally year by year. And you look back after 5 or 10 years and you see big shifts have happened. But we're getting massive accelerations in these sorts of structural shifts. So, retail online, working from home, and all the technological aspects that go with that, the urban to suburban moves as commuting becomes less necessary, perhaps on a permanent basis. International to national in terms of tourism and all sorts of other business. There's a whole bunch of structural changes that are happening really, really quickly relative to the sorts of pace we normally see. And obviously, if some of these changes need technology to facilitate them, but the force of change and the speed of change will be so. I think that's the way I see technology coming into this. If you get in the right sector that's positioned to facilitate these huge shifts which are taking place in the way we work, in the way we spend, in the sorts of places we decide to live in, and how much time we spend in the office versus out of the office. I think that's where the technology will play a huge part in those transitions.
Excellent, Brian. And I will stay with you because we've only got you for a few more minutes. So very, very quick final question before we have to say goodbye to you. And obviously, at the moment, we're seeing unprecedented levels of government borrowing. I've got a nice question here. Just maybe you could give a few minutes on what is your medium-term view of 10-year treasuries? So anything you could add on 10-year treasuries for Sanjay, who's posed this question?
Yeah, I mean, prior to the pandemic, we were kind of our view here was sort of relatively in the hawkish camp, that we didn't really buy into this story that there'd been this massive decline in the equilibrium real interest rate, which meant that interest rates could settle at much, much, much lower levels for the medium term. We thought that those arguments, it's called R* in the economics policy debate, that the R* had collapsed because of this surge in saving. Didn't really buy into that. So we sort of had a view before the pandemic that over the long term, if we're looking out 5-10 years, that the equilibrium Fed funds rate in nominal terms would be probably positive 1%, something like that. So in real terms, so you add the inflation target, you get to something like 3.5 of Fed funds, and then you add a little bit of a term premium, and you get to something 3.75-4% for where the 10-year yield would eventually go. I think the expansion in central bank activity in the bond market through the pandemic response has been so big, and I think it's going to be very hard for them to start unwinding that anytime soon. I'm expecting another leg up here. I think that's sort of that has changed things on on a fairly long-term view. You know, unless we start to see evidence of inflation, I think this is a bit of a regime change. You know, the central banks are going to be so active for so long in this market because governments have got so much more debt. It's going to be very hard for them if interest rates do rise. You know, traditional there's limits to how far you can go in terms of negative policy rates. You know, I sense quite a bit of reluctance. You know, the Bank of England's talking about it a lot, but will they actually go there? I still somewhat doubtful. I don't think the Fed will go there. So the balance sheet is the key instrument. You know, we're heading into some renewed downturns in Europe. We're going to see central banks ramping it up again. So I think we're in this world of what you might even call sort of financial repression for the long term. So we do expect yields to rise. I don't expect them to stay below 1%, but yeah, 4% even in 10 years' time seems unlikely to us now. This is even lower than we had before for even longer.
Thank you very much for that, Brian. So I don't know if Juliano, do you have anything you would like to add on that question?
No, I think that it is very good summary of that.
Okay, that's wonderful. So I was thinking at this moment it might be a convenient time for Brian to make his way to his next meeting without opening another topic, perhaps, which might take us over our 4 o'clock deadline. So, Brian, I would like to extend an absolute massive thanks from everyone at Cbonds that you've taken the time out of your busy schedule to participate in our webinar again. It's really very much appreciated, and we do hope you will join us again in the near future.
Thanks, Will. Thanks everyone for dialing in. Okay, thanks. Bye-bye.
We have another question, however, from Simon Petit, but I believe this will be better addressed in the next section of the presentation. So I will read it out and we will just hold it for the next section of our presentation, which will then be moderated by Lana. So the question will be from Simon Petit regarding high-yield bond deals to be found in the private assets market from between $50 and $100 million, listed bonds deals which are well secured and pay coupons between 6 and 9%. So that's a question we're going to address in the next part of the presentation. So I think, Juliano, we do have a question. I know you're quite the expert when it comes to emerging markets, and I've got a question here now regarding the Egyptian economy and Egyptian treasuries. Do you have anything that you would like to say? What are your views on the Egyptian economy and Egyptian treasuries at this point in time?
Yeah, I mean, I'm not sure if I'm going to be of huge help here, apart from the fact
quite
that
specific. So it was a yes, quite a
I think that it is fair to say that I can see that the Egyptian economy has done much better than you know the say most emerging markets in general, but yeah, no, I don't have any specific
Absolutely. And any another question we've got from Leon Afamov. He's asking for specific recommendations with the US dollar traded high yield bonds. Do you have any sort of things that are particularly interesting at the moment that are really jumping out at you just off the cuff in the particular climate that we're seeing at the moment?
Yeah, I don't want to talk too much about specific trade ideas, you know.
This is fair.
But I'm going to say that in the US, I think that there are certain, let's say, European issuers of US dollar bonds that people should look at closely. Okay, for example, Algeco, it is a company that also, European company that also has a lot of dollar bonds. You have and Algeco is effectively they got rid of their oil and gas exposure last year, just before you know, very fortuitously, right, just before oil tanked all the way down to 40. So Algeco is not the old Algeco. It's now a company that is mainly exposed to construction, emergency housing. So it's a completely different profile. And I didn't have that in my slides, but one of the things that people got wrong during this very initial early stage is that a lot of people, I think, reacted to a lot of these bonds by their old, you know, their legacy mental image of a lot of those companies, as opposed to to what the company had become, in terms of structurally speaking. So Algeco used to be very, very little oil and gas exposure. Now used to have massive amount of oil exposure, which almost sunk them during the 15 period when the last oil downturn. So, for example, I just one thing that you could potentially look at.
Wonderful. Now, thank you very much, Juliano. We have a couple more questions. I don't think we're going to have time. We're running a little bit ahead of schedule. But I think at this point, it might be quite prudent to hand over to my colleague, Lana, and start on the next part. And I'm very happy to introduce my colleague, Lana, who will now be moderating the next section.
Hello, everyone. Thank you for making it. It's a big day for everyone, for all the markets. So thank you very much for joining us. I would like to thank Brian and Juliano for making the overview of the markets, and actually just to write a few lines and say a few lines about the regions where are the risks now. It is actually really great that we are following and moderating the situation basically rather constantly, as I hope you also attended our seminar last week with Andreas Bickel from Blackford Capital. So now we'll move to a bit more practical things, and I'm actually thrilled to move forward with the discussion with portfolio management managers, and actually we'll try to answer the question, where are high yield bonds now, as basically this question was rolling into the head of the investors probably all the year. Frankly speaking, I was really anticipating this discussion, and if I'll tell you a few words about these speakers, you'll understand me. Why? So today we'll discuss some investment ideas with the high yield globally. It won't be not only emerging market. If you thought initially, it will be rather globally. We'll think about these ideas and bonds with different angles, and later on we will focus on the Latin American market. Well, basically, I just don't want to miss our opportunity to speak with people who are basically from the emerging market, from Brazil, so they are local, they know and understand the market way better. So this is your chance to be more active. So please leave your questions into the section below. Now I'm thrilled to pass the floor to our first speaker with Marc Bourget. He works as a senior investment manager from Bank Vontobel, one of the remarkable banks in Zurich, in Switzerland. So Marc is actually responsible for managing different tailored mandates, and well, basically with the focus on high yield. That is why it will be absolutely interesting with him to speak. And additionally, he has really nice choice for work. He taste for work. He previously worked at PicTef, then in UBS, in Julius Bayer, and now. So I would like to introduce Marc to join us, and I will be assisting to Marc showing his presentation. So Marc, please.
Thanks for having me. So I think the question is of great interest to many investors, and the way I'd like to break down this question, it will be in two parts. First, if you go on the next slides, I will walk you through the agenda. Perfect. So the way I'll try to break down this discussion will be in two parts. I'd like to walk you through what can we expect from risk assets overall for the high yield markets. So I will show you a few tools, how we do it at Bank Vontobel. And what is also very important, and that's also on the part 3, it will be to really understand the credit cycle, because no matter where we are in terms of yields, in terms of spread rates, it's important to really capture the credit cycle in order to position the portfolio adequately. And the last leg, we will talk about a few ideas on how we implement it. So if we go on the next slides, so what to expect actually, I think everyone is well aware, and it has been touched by Brian also earlier before. We are walking through quite a tight rope, I would say. Trying to balance the American leadership uncertainty. What would be the political decisions, and this will be key in terms of seeing some more potentially fiscal as well as monetary support for the markets. But also what has been also shaking the bond market tremendously has been the so-called second wave of the COVID-19. And so those type of, let's say, strong headwinds are putting quite an important weight on sentiments. But despite this uncertainty, I think it could be for us, let's say, quite interesting to add risk to the portfolio if we see any material sell-off. And here, I think I'd like to walk you through, I think, 3 themes that are quite important. I mean, first is in regards to the cyclical theme. As we're seeing with the lockdown in Germany, France, and Italy, all the COVID disrupted and also cyclical sectors of the high yields have been moving sideways, and potentially, depending on how long those lockdown last, it could have quite an important, I would say, cascading effect on the high yield markets. So for us, if we want to move more into, let's say, cyclical themes, we should wait for a better catalyst for that to happen. So, and here are those, I think, 2 important themes. I mean, we have seen firms last week, but also this week on the reporting season. I would say the picture has been relatively constructive. I mean, we have seen Ford, for instance, which have come to the markets with quite a solid revenue, also on the EBIT side, generating free cash flow. So this is something very important to follow. We have seen also some good results from General Electric and some also oil firms such as Eni and BP, and those have been also quite constructive, I would say. What is also key is to follow the activity on the US energy sides. Many of the deals which have been done are equity finance transactions, and there on the M&A deals, there could be some interesting bond to look at. So overall, I think following the shock on the COVID-19 that has hit us dramatically in March, we were, expecting, I would say, some earnings which, let's say, much lower than expected. But the results have been, I would say, quite good on the contrary. And obviously, when we have seen those huge action of central banks, such as the Fed and the ECB, and supporting the markets, this has somehow put a threshold on potential downgrades and so-called falling angel. So let's say many firms, especially on the investment grade side, have shored up their liquidity. They have boosted their cash. They have issued record amount of debt in order to protect their balance sheets. So many of the action that firms have taken have been, I would say, quite credit positive, and this leaves us as well with quite some comfort. If you go on to the next slides. So here, that's in a way the snapshots, and that's the way I like to think about the markets. This helped me also to guide through the decision that I'm making in the portfolios. So on the macroeconomic side, I would say I'm more neutral to cautious, meaning we have macro indicators, following a second lockdown, which has putting some pressure, but we have hopefully, or we will see a recovery in 2021. On the other hand, the massive fiscal packages have supported markets. The many bonds also in the high yield markets have tremendously rallied, but more is needed. I mean, central bank action are very important. They have to happen, but the question will last. I mean, the last question is, would it be enough? When I move more into fundamentals, I think here it's clear that credit metrics have been deteriorating. Even though many firms have been quite prudent in terms of their liquidity management, bonds on the IG but also on the high yield space have been able to tap the markets. They've been able to refinance some of the positions, so that was actually quite positive. And the reporting season, as I mentioned earlier, the reporting season was quite okay. So I would say quite constructive results. So let's see, especially how far and how long with the lockdown lasts. So on the technical space, I would say there are more. I would say more neutral. We have seen quite some inflows, some risk off as well in the last few weeks, but more or less, following the intervention of the Fed and the ECB, we have seen some quite interesting inflows into the high yield space. And on the new issue sides, we have a slowdown in activity, and we could see on, I would say, the non-disrupted sectors by the COVID also some very strong oversubscription. Book orders have been quite full, and the premium have been getting tighter and tighter though. So I would say on the technical, I'm more positioned as neutral, and the only bucket where I think we could add some value is really on the valuation side. And on valuation, we are quite positive. I think credit spreads are actually interesting. They are at quite attractive levels. So they have obviously tightened quite a lot from the extreme levels. But still, when you can add into your portfolio, I would say 300, 400 basic points, I think it's quite nice to have. And on the rates, so rates are expected to stay low for longer. But the question is, and it's related as well to the election on the medium term, if we see a blue wave election, this will clearly step on the yield curve. And on the next slides. So the next slide is what I mentioned right at the beginning of the agenda. And this is something that I like to do quite regularly. So this is a judgment that I write. I like to write this into paper and try to understand, where we are in the cycle. So what I do is I take, all the aspects that are for me key, ranging from the economy, the outlook, how is the capital markets, what are the terms, the interest rates. And as you can see on the right-hand side, you have adjectives. We do qualify, where we actually stand. And I put a rating, on each bucket. So are the lenders, eager to lend, or are they reticent? If you look, for instance, at the market, is it a market that is more crowded or starved for attention? And I do this, every month in order to get a better understanding on where we are in the credit cycle. And as you can see, or as you can guess, the more, let's say, the picture will tend to the left-hand side, actually, the more defensive I would get. So in this current environment, we have plenty of macro risk, that we discussed earlier. And we are entering as well a late cycle. And I would say many mistakes that investors have done in the past is, when you have rates at the bottom, yields, starting to get low, they usually make the same mistakes and they try to go down in quality in order to get more absolute returns. So I think it's more a market, a high-yield market where you have to be prudent, especially where COVID has disrupted as well some solid company which were in place, before the February and March events. So it's very important and it's very key when you invest into the high-yield markets to do it in a more defensive approach. So that's a little bit, my takeaway on the markets and how I like to think. And if we move on the next slide. So on the next slide, I'd like just to illustrate a few ideas and how I like to play this thematic. And as I think all of you know, when you look at the US energy high markets, it has been smashed as well by having oil prices sinking to a record low. And here I'd like to illustrate a concept that is quite interesting, meaning I like to focus on M&A deals. And sometimes, when you have special situations and you have a bigger player acquiring, let's say, a smaller, you have usually, for the smaller player, you have an improvement into the credit metrics by having a big one acquiring a small one. And here, that's also an interesting case. So Cenovus Energy agreed to buy ASKI Energy. So this deal has been confirmed and will materialize, end of Q1 next year. So obviously, you are moving here into a sector that has been, that is quite struggling. But what is the key here, and what is the interesting angle, is by making such a transaction, you have a drastic improvement into the net leverage. So basically, you have a firm, that is trading at, I would say, a net leverage to 4.6, 4.7, and by materializing this transaction, the credit metrics are drastically improving, to more than 2 times. So you are moving, for 4.6% into 2.6, which in fine means that what will happen on this bond is that you will have a strong move towards investment grade. So this bond is clearly a rising star. And when I mentioned about special situation, what I meant is, when the announcement came that the bond would be acquired and the deal will get closed by the end of 2021, I could purchase significant amount of bonds close to par. So I bought this bond, slightly above par, and it has shoot up really nicely. And I took also a very good profit on that, and in a very short time period, in less than 24 hours. So I think here the angle is, and this is something that I like to do, is I like to look at M&A deals, right? And in some circumstances, when you have done your due diligence and you know that something will materialize, then you will have a spread compression of more than 100 basic points, sometimes or even more, 200 basic points. If you multiply it by the duration, so you would roughly know how much profit you would make on such transactions. And I think U.S. energy sectors will continue on that. Many of those deals have been bond friendly, have done through some equity M&A. So this is definitely a sector that has been struggling, but where you can find some interesting value. If you move on the next trading idea, I'd like to illustrate, I would say, a pocket of the high yield markets, and here I'd like to talk about structural opportunities. As you know, regulators, ranging, and also regulations, ranging from Basel IV to Solvency II, impacting banks as well as insurances, will have tremendous impact in terms of rules that applies for capital that banks or insurances put aside, right? And in that particular space, I mean, if you look here at the legacy debt, I mean, the legacy debt is a very small pocket. It's roughly a market in US dollar of 20 billion. Here, you can find some interesting angles. So you know that for instance, the European Banking Authority will make some clarification in terms of the legacy rules past 2022. So here you have a regulatory angle to which banks have to comply. For insurances, this will be in 2026. And I highlighted a paper that I found quite interesting. And this paper, I bought it in the low 80s. It's currently trading at roughly at a level of 89. So here I've done two things. I mean, first of all, I think it's very important, when you acquire any type of asset as well into high yield markets, that you focus on relative value. So you look at, similar rated banks or, banks with similar profile, where, you are also quite confident that, you are buying something that delivers, I would say, a value in its, let's say, buckets, its rating buckets, but also in his sector buckets. And when you acquire such assets, on top of that, the beauty of that bond is that I get a free option, and the free option is linked to actually regulation. So the banking authority actually will look at four distinctive I would say aspect in order to call back or tender or make wall provisions on some of their bonds. And one is related to LIBOR. So when you look into the bond prospectus, if there is no fallback language on the LIBOR, this might be something to look very closely, because the bank has to take an action. So that's first item. The second one is whether the bond has been issued by the SPV. So the emission on the SPV actually is also very important to know, yes or no. Another question is this bond has been issued through a foreign entity, and what about the retail share class, right? And what you know is more angles you have on those type of bonds, right? The higher, and also based on the founding condition of banks or insurances, the higher would be the chances that such bonds have an impediment resolutions. So in that particular case, this bond is counted as tier 2 paper, right? So when the bond is counted as tier 2, and you are part of this grandfathering period, so you have a good chance that the bank at a certain point in time has to act on that paper. So here, I wanted to illustrate, I would say, two very important concepts. That first, that you get, when you buy a paper, that you can get it for a decent price, a decent value. But on top of that, try to get a free option if possible. That's related to the second idea. And then I will jump to the third idea. So on the third idea, here is, the search for yield premium. And, when I take a firm like Telecom Argentina, I think this is an interesting bond that I like to illustrate. Is you have a firm that, from a balance sheet standpoint, that is quite, I would say, that is quite solid. I mean, the firm is able to write, is positive free cash flow. The credit metrics are quite good. So, based really on the balance sheet and the capacity of the firm to produce a decent amount of cash flow and as well predictable cash flow, you have a bond and you have a firm that I would say, right from its characteristic it is quite solid. However, the the firm is placed in a market that has been modeling through and also suffering through the restructuration. Argentina has been in a very difficult posture. And what I like about this bond is I bought it when the day when we got some more clarity, between the bond holders and as well the states, where they were able to renegotiate, some of their outstanding debts. And this gave me, I would say, quite a positive signal. And you have here a huge amount of sentiment driven that is pushing up a yield. And so you could acquire here a paper that I found really quite good. And if you ask yourself a question about solvency, I think solvency risk for such a bond is very limited. If you look at funding, because that could be another aspect to consider. I mean, funding, they have quite some strong relations to other banks, and for instance, Deutsche Bank, which has been a provider of bonds to them. So even if for whatever reason some huge amount of uncertainty would remain around Argentina, you will have still a bond that, according to what I know about the firm and also its relations with other banks, I think we have a firm that can roll down its debt. And they have done they have rolled the 2021 paper partially. And the beauty here is that you could go quite short in duration, right? You have I would say quite a huge uncertainty in regards to the sovereign, obviously. But I'm strongly believing that you could acquire quite a decent bond and getting a very good and very attractive yields. So I mean, here the concept that I would like to extrapolate is sometimes you can get some very good values and some firms that are also well run, where I believe the yield that you get is worth the risk that you are taking. So this is it for the three ideas. I've seen that there have been quite a number of questions in the chat.
Marc, thank you very much for your presentation. I believe a bit later when we'll have a discussion, we'll even discuss your ideas. I'm sure our audience have a few questions, even I do. Thank you very much. Then I'm passing the floor to our next two speakers. Well, basically, we'll have Alex Carpenter from Trafalgar Investments and Alan Glezer. Basically, I should say that we'll focus, of course, on high yield of Latin American markets. And let me give you a brief intro. So at first, we'll start with Alex, and he'll make a brief intro on the market in general, draw a few ideas on the particular issues, and later on we'll pass to Alan. Then he'll will make a case study, which I promised you to everyone. So Alex, he's a partner, he's a co-manager of this fund, which is focusing on Latin American high yield. I should say why I really wanted to focus directly on Latin American market. Of course, at first, those speakers which are analyzing the whole market, so of course they know better. But if we speak about even Alex's background, so apart from being portfolio manager of the fund with around 3 billion under management, which they are doing right now at Trafalgar. Initially, he worked at Itaú. He also worked in Moody's, so he definitely the right person, and he knows the level of risk of each company. He worked at HSBC and Invesco priorly. So I'm thrilled to hear your opinion on the Latin American market. And please, Alex, join us.
Yes, I'm here now.
Good. I've been worried.
You can hear.
All right. So how are you today?
Good. Okay, so just as an overview, Trafalgar is a firm based in São Paulo, Brazil. It was founded in 2017. We have about $1 billion under assets under management and advisory currently. It was a group of executives coming from UBS, Itaú, Moody's, like myself, Credit Suisse, that basically wanted to do things the right way in terms of what we thought about wealth management and our experience. All of us had more than 20 years experience in the markets when we founded Trafalgar. So about myself, you can probably tell I'm actually American, but I lived for more than 15 years in Brazil. My wife is Brazilian, so that was part of the reason, but also because I enjoyed working in the financial markets in Brazil. So I currently am in the United States. After we founded Trafalgar, I moved to the United States because of my wife, actually. She had an offer with Bank of America here in Charlotte, North Carolina. So that I had to, after we founded Trafalgar, I had to start working remotely. And then after that, we got what we got with the COVID. So everyone started working remotely, and it wasn't a big deal anymore. And my clients got more used to it also. So it was actually, from that point of view, not such a bad thing for me. So anyway, I think we can go into the presentation here. The first slide, just looking at where we are in Latin America and emerging market high yield versus before pre-COVID levels. We're still about 200 basis points above pre-COVID levels in terms of the spreads right now. You see Latin America, the two last indexes here, the black and the light blue, are both BB rated, more BB ratings focused indexes. So that's why they have lower spreads. Whereas, the emerging market high yield has more B ratings in the index. But all of them are more like 200 basis points above where they were. So I think the spreads are still fairly attractive, but I think it's a moment for active management and to be cautious because in a downturn, things won't all perform the same going forward. And sort of the levels that we had back in March, April, even May, that things were obviously cheap. I don't think they're obviously cheap anymore. We had our fund can go anywhere from 80 to 150% in terms of net exposure. We got up to about 125% net exposure, and now we're back almost to 100 at this point, just waiting for opportunities. So yeah, so go on to the next slide. So talking a little bit about two of the main sectors, about half of Latin American bond market is pretty much these two sectors, the oil sector and next the bank sector. After we'll look at that. So obviously they're cyclical sectors. So like I kind of agree with Marc's comments about cyclicals that maybe we need to wait a little bit and look for opportunities in most cases. But here on this slide, we illustrate a bit of an opportunity, perhaps. We have the Petrobras, Ecopetrol, which is the national oil company in Colombia, ENAP, which is the national oil company in Chile. You see all those three are trading more or less 100 to 150 basis points over their respective sovereigns, which makes sense. They should trade tight because they're all still partially or fully owned by the sovereign, less so in the case of Ecopetrol, more so in the case of ENAP. And then we have Pemex that is trading at 550 basis points above sovereign for one of the most common bonds. So this is historically very high maximum levels. And basically it's an opinion at this point whether you think that this is sovereign debt or corporate debt. I'm personally of the opinion that I think it's sovereign debt, even when you look at the IMF debt that Mexico has. Pemex debt is included in the Mexico national debt for the IMF purposes. So there are a series of reasons why, and we talk about this all the time, but we currently hold the Pemex 2031. And also we have part of our position in the Pemex 2022 floaters that traded at about par and paid LIBOR plus 365 basis points. So there are two interesting opportunities there. So we can move forward to the next slide. So just in terms of the banks, you also see that spread over sovereign is lower outside of Mexico and higher in Mexico. So for Brazil, you have Banco do Brasil, which is owned by the government. So there's some reason to expect sovereign support there. Even the perpetual bonds in this case trading at 200 basis points. So this is subordinated debt, right? B rated. So Banco de Bogotá in Colombia, here is not owned by the government, but also trading at 100 basis points above sovereign. It's a very well managed bank and spreads have come in. Banorte and BBVA in Mexico are both trading, 300 to 500 basis points above sovereign. BBVA is the largest bank in Mexico, actually, and Banorte is also a major player. So both of these banks are trading very different than the banks in the rest of the region. So going sort of back to what Mark said when he was looking at Telecom Argentina, there's some cases where you're getting paid for the risk that you're taking, which we think is the case in the Mexican banks right now, and not so much in the banks in the rest of the region. Okay, we can move on to the next slide. So just talking a little bit about the issuance and the investor base in Latin America. So we have a large base of EM dedicated and US investors looking at Latin American bonds, not so much local investors. The local investor base is growing. There is a trend which we are part of, where local funds, meaning local in Brazil funds, are being launched to partially invest in offshore debt. This is something that never happened in Brazil until the last 2 years ago. It didn't make any sense because you had high local interest rates, and when you swapped the bond yields back to real, you didn't really get any premium. Now, when you swap bond yields back to real, you get a premium versus the local interest rates, and it often makes a lot of sense. So that's why these funds are being launched at this point. Brazilian interest rates are at 2% a year right now, which is very negative in real terms. So in terms of issuance, this year is looking very similar actually to the previous years and last year and even other years in terms of the issuance in Latin America. So that's good news considering what the news that we've had and the stress that we've had this year. We even think that there should be some cash flow left over for more tenders and buybacks by the end of the year. So that's something that we're starting to see more of and should continue. If you look at Latin America high yield trading below $50 or below $70, we're not at the very stressed levels that were reached in 2015 or 2014. They came up a little bit, but not so much. And the default rate 1 year forward, it's coming up, but we haven't had any major defaults in the region yet, and I can't think of any that I expect in the near term that have higher ratings. So that's pretty much what I had as an overview. Myself and Alan Glezer manage the fund that we run out of Trafalgar. As Lena mentioned, my profile is spent a lot of time at Moody's. I was head of Latin American debt corporate issuances or corporate ratings at Latin America at Moody's for a time, and traveled through the region, helped the analysts with the team in the region. So that's something that was very helpful to me. And also I was at Itaú and HSBC managing Brazil and Latin American focused investment funds. Alan worked at most recently with Bradesco, one of the largest Brazilian banks, as an analyst covering the commodities sector, cyclicals. And he also was with the hedge fund Spinnaker for quite a while, working with the bond markets. So we're both CFAs also. So I'll hand it over to Alan to look at a case sort of linked to what Juliano said about people sometimes are overly bearish. And we think that the case study that Alan's going to show is an example of where people were overly bearish and probably are continuing to be overly bearish. So with that, I'll hand it over to Alan.
Absolutely. Thank you so much.
I work here at Trafalgar. I'm currently based in São Paulo, and I've been covering the metals and mining sector for a long time. So here at Trafalgar, we manage a portfolio, a fund of high-yield bonds focused in Latin America. Now I'll talk about CSN. That's one of our key positions in the fund, but we can explore other names in the region later on the Q&A section. So here I put together a few of the peers of CSN around the globe. I will talk about CSN. CSN is a mining and steel company based in Brazil. It's actually the second largest iron ore exporter from Brazil, Vale being the first one. This is a very large market, iron ore. So basically China is importing close to 1.1 billion tons per year. This is roughly around $130 billion of sales on a yearly basis. And CSN is the widest name here that we have. The spread is currently around 640 basis points. Nowadays, it's very hard to find a name paying a yield of 7%. And CSN is one of those cases. So as you can see here, CSN is trading wider than Usiminas. Usiminas is another name in Brazil. It's actually one of the largest steel makers in Brazil. So we have CSN and Usiminas. Those are the largest steel makers in Brazil. And given that CSN is currently generating most of its revenues from mining, from iron ore exports, I've also included Fortescue in Australia and Rio Tinto also in Australia as a comparison. So as you can see from here, CSN is currently trading with a 650 basis point spread. And this is much wider than the current level of Vale, around 250 basis points, and even wider than Usiminas at 500 basis points. So we're going to explore a little bit why this is happening and why we believe this is an interesting investment case for the current moment if you're looking for a high yield bond paying more than 7%. Actually, if we were to compare, there is another peer outside Brazil. It's actually Metinvest. This is an Ukrainian-based company, and they have a similar kind of revenues breakdown. They generate revenues also from steel making and iron ore mining. If you look at the EBITDA generation, the cash flow generation of Metinvest is also 70% coming from iron ore and 30% coming from steel. This is very similar to CSN. CSN is currently generating 75% of its cash flow from iron ore and close to 25% of its cash flow from the steel division. If you look at the rating for Metinvest, we are talking about a single B rating from S&P and a double B minus rating from Fitch. This is slightly higher than CSN. CSN has like a B minus rating from S&P and a single B rating from Fitch. So this is a name that we like to compare to, like CSN and Metinvest. But let's focus on CSN for now. Sorry. Okay, so let's go ahead. So let's briefly give you an overview of CSN and what's going on with the company today. So CSN has a market cap of $5.3 billion. The stock price in local currency is up 50% year to date. And if you look at the dollar in dollar terms, the stock price is up 8%, mostly because of the currency depreciation in Brazil that depreciated around 42% year to date. They have around $5.6 billion in net debt. Over the last 12 months, we had around $1.5 billion of EBITDA. and for around $5 billion for revenues. The controlling group is the Steinbrück family, based here in Brazil. There's been some controversial comments about how they manage the company, but we believe that they are doing like a very good job facing this current crisis and managing the company in the best possible way. As I mentioned before, the EBITDA generation, that's like a proxy for the cash flow generation for the company. 75% it's coming from mining division, that's iron ore exported mostly to China, and only 15% coming from the steel division. And this is mostly flat steel that is sold here in Brazil for the automotive and construction sectors. If you look here on the right-hand side, in terms of revenues, they were generating around 4 billion reais per quarter in revenues back in 2016, 17, and this number has now gone to a level above 8 billion reais in the last quarter, where they benefit from the more depreciated currency, more depreciated real, and also from the very high iron ore price level that we've seen recently. In terms of EBITDA generation, it was also a very good quarter. So basically they were running with 1 billion reais per quarter back in 2016, 17. And now in the last one, they generated close to 3.5 billion reais in EBITDA. And that's a very good also EBITDA margin. It's also almost close to 40% EBITDA margin in the third quarter. And this is much higher than the 25% that they were running back in 2019. So actually 1 year ago. So the EBITDA margin expanded in a very good way. We can move to the next slide, Lana, please. So now let's focus a little bit on the iron ore division. They've been running with like a very stable sales level in terms of iron ore. There was an impact in the second quarter of this year, mostly due to the COVID situation here in Brazil. The COVID situation in Brazil has improved a lot from June, July until today. So there are no obstacles for CSN to operate in their regular way. So the situation improved a lot. Now that CSN is operating in terms of production volumes in a normal and a regular way, they can benefit from the current iron ore price level. We are talking about $120 per ton. So this is a very high level. If you compare iron ore with other commodities around the globe, you're going to notice that iron ore has performed quite well in the recent crisis. So the price was actually around $90 per ton before when COVID hit the economies around the globe in a harder way. And then we had a positive reaction that was mostly driven by what we've seen in China so far. So basically in China, they had a lot of stimulus, basically on the construction side and also on the machinery side. So you can see here on the chart below, the steel production in China reacted very fast following all the stimulus that went through the Chinese economy. And we've seen these moving into the iron ore price level. And at this price level, $120 per ton, CSN is able to generate a lot of cash. Basically, they can deliver the iron ore into China at around $40 per ton. So if the current price level is 120, there is a massive free cash flow generation for CSN on the mining division. There is another detail that I will mention a little bit later here in the presentation, and it's a key driver for the future deleveraging of the company, is indeed the IPO of the mining division. So CSN is considering spinning off its mining division and selling a stake to accelerate the deleveraging process inside the company. So basically here the message is that it's very positive from the mining division. If we could go for the next slide, please, Lana. Now focusing a little bit on the steel division. First on the left-hand side here on the top part of the slide, we have the industrial production and also the energy consumption in Brazil. The industrial production in Brazil was hit very aggressively during the peak of the COVID period. So we had a contraction at a certain point of 25% year on year, contraction for the industrial production. But following the hardest moment that we've seen for the crisis back in April here in Brazil, we've seen a massive recovery, and now we are reaching a level where industrial production is flat year on year. So this is very good for CSN because mostly the impact for them was on the automotive sector. You can see on the chart here below, on the pie chart below, that the automotive sector today only represents 5% of the steel sales, but in a recent past, this number was close to 20%. So basically here we had a massive contraction of the sales to the automotive sector. That was the sector that was most heavily hit here in Brazil during the crisis. On the other hand, the construction sector in Brazil is doing quite well. We've never seen such a low level of interest rate, and there is a boom here in the construction sector for Brazil. And CSN has been able to shift some of its sales from the automotive sector to the construction sector, therefore offsetting some of the negative impact that came from the COVID shock. Also, they have some exposure to the packaging sector that has been very resilient over this period. Home appliances, it's difficult to see these, but here in Brazil, home appliance sales, they increased during the COVID period as people were staying home more often, and they decided to change some of the old appliances that they had. So now in the third quarter, we already seen the steel sales coming back to the previous highs. So for the steel division, the volumes are coming back to what they were before. And also, as you can see from the right-hand side here on the top part of the slide, the steel price has increased over this period, mostly driven by the Chinese increasing demand for steel. It increased from like around $480 per ton to $600 per ton. So that was a 25% increase in steel price. And also here in Brazil, as I mentioned before, we had the currency depreciation. And this is good for CSN as they can increase prices in a more aggressive way here for the Brazilian clients, given the currency that the price of the steel here in Brazil is driven by the price in reais per ton and not dollars per ton. So the message is also very good from the steel division. It was very hit over the second quarter, but now coming back to normal. If we could move to the next slide, please. This is a very important slide, in my opinion, for CSN. They had a very high level of leverage in the second quarter. So the company was running with a 5 times net debt EBITDA in the second quarter. Now the number is already down to 3.5, 3.7 times net debt to EBITDA. So this is mostly driven by the very healthy cash flow generation coming from the mining division and a boost in EBITDA that also came from the mining division. The company is very optimistic with its prospect now going forward, and they are talking about a level of leverage by the end of 2021 that would be close to 2.5 times net debt to EBITDA. So they believe that this current level is still stretched, and they see more room to bring down the leverage to 2.5 times. In terms of liquidity, I myself believe that they will be able to reach this level of 2.5 times. Even if they don't reach 2.5 times and they stay at around 3 times net debt to EBITDA, I believe that a spread of 650 basis points, and that's a yield of 7%, is too high for a company like CSN running with a leverage of 3 times net debt to EBITDA. In terms of liquidity, they only have bank debt maturing over the next 3 years. So 2020, 21, 22, only bank debt. And this is mostly local bank debt. So it's much easier to roll. The next significant bond maturity is only in 2023. They have a good liquidity position. So they are currently holding around 6 billion reais in cash, and that's enough to cover the maturities in 2020 and also in 2021. So in terms of liquidity, they are in a good shape. For sure, they don't have enough cash to cover the maturities for the next 4 years. But I believe that given the kind of cash flow generation that they've seen so far in the recent quarters, they might be able to roll those debt maturity in 2021 and 22 very easily. So if you could go to the next slide just to finalize here on my side. So as I was mentioning before, there is a project in place right now. That's the IPO of the mining division. So CSN is planning to spin off its mining division and sell a stake. There is like a sensitivity analysis here on the bottom right-hand side of the slide. Basically here we are talking about the size of the stake and the valuation. So let's assume the medium level here where they sell 25% of the mining division at a EV/EBITDA level of 5 times. They could reduce the leverage to 2.5 times very fast if they go through this process of IPOing the mining division. And it seems like they are making some progress recently here in Brazil. Just one last point about CSN. Some people could be concerned about what happened to Vale recently, especially given that ESG has become so important for investors nowadays. Remember that Vale had a tailing dam accident just a short while ago. It's worth mentioning that CSN is operating currently only with dry stacking, so they do not use tailing dams. So that's a very important point to mention here. So the risk for CSN is basically zero, as they are not using tailing dams at all. And one other point that is worth mentioning is that given that the reserves that CSN has in its mining pits, they could increase the current volume of around 40 million tons per year of iron ore production. They could increase that to above 100 million tons per year of production. So there is also a very interesting potential growth story that could come out of CSN. So just to summarize CSN here, so it's a company that is bringing leverage down. They are surfing this very favorable momentum for the iron ore market. They are also surfing a positive momentum for the steel market in Brazil, where industrial production is coming back online. They are now working on the sale of the mining division, of a stake of the mining division that could further accelerate the leveraging of the company. And lastly, it's one of the bonds. It's not very easy. We have like a very good screening for bonds in Latin America, and it's not easy to find a name that is paying a yield of 7%. In this kind of world that we live in today, it's not easy to find a company actually around the globe paying more than 650 basis points of this spread, given that most of the names are trading very tight right now, even comparing to the levels that we had before COVID. So I guess that's it on my part. I'll be happy to share my thoughts on other names that you might have any questions in terms of names in Latin America. And I myself and Alex, we are available now for the Q&A section.
Perfect, Alan, Alex, and Mark. Thank you very much for sharing some pearls of the market. As I really, while you're showing all these slides, I was checking the prices, and for some bonds, they are really stunning. So I would like to invite each speaker of this section. So please, Alex, Mark, join us for the discussion. I would like to invite each participant to ask your questions, as I'm sure high yield bonds are the main curious thing for each of you. While I'm picking the question, we actually have the question between the speakers. This is also very curious. So, Marc, Alex is wondering whether you can explain why you think that yield spreads are a bit wide, but prospective returns are low. So could you comment, please? Please switch on your microphone. Thank you.
Yes, so I think we agree that spread, and that's exactly what I showed earlier in the presentation, that when we talk in terms of spreads, in absolute terms, spread I would say are quite attractive. When you look at the CDX high yields, you are roughly at 400 basis points. So only from, let's say, a spread perspective, I think valuation are quite decent, and that's why I'm quite positive talking about valuation purely. But unfortunately, when you look at expected returns, expected returns encompass much more than spreads, right? So you could have rates, and depending on how you decomposed, you expected returns, you might have other features, right? And just by looking at rates being so low, and the potential, of having a blue wave, and also a yield curve, especially on the back end of the curve, based on if we see some more stimulus going forwards, the chances that the yield curve actually on the long hands moves, for me, it could be materialized. And that's why in some of my strategies that I manage, I also bought steepeners as a hedge for a yield curve moves. So when you combine those macro events where potentially you could have a long hand of the curve moving, rates are extremely low levels, and also inherent risk when you look at expected return, because you look at the distribution of return. Obviously the only constructive aspect is in regards to spreads, but they are much more than spreads. And that's why I think when you adjust also by the risk elements, I'd be rather on the defensive camp.
Curious to hear. All right. Thank you very much, Marc. Then we have a question from the audience. It is rather curious, as I believe this issue is in the portfolio of probably each investor who invests in more or less high yield. So I would like to ask maybe Alex or Alan to comment. What are the risks on the longer PMX bond, and why not why to bet in a leverage company with oil going in stress levels and pressure prices lately? So you mentioned that you have PMX with different duration, as far as I remember. So what are your advices in terms of long and short duration?
Yeah, I think PEMEX really, if you look at the fundamentals of PEMEX, like spend time looking at the balance sheet and the income statement, you're probably going to commit suicide within an hour. So it's not really worth looking at those. Really, PEMEX the discussion is whether PEMEX is sovereign risk or not. That's really the discussion that you need to have.
And then I have another question. So PEMEX is Argentinian company, right?
No, PEMEX is Mexican.
Sorry?
PEMEX is Mexican, the Mexican.
Oh, Mexican. Okay. So what about Argentinian corporates? I wonder, because Argentina is actually has challenging times.
Yeah, well, so our fund, basically our mandate is to invest only in countries or companies based in countries that have a rating better than Brazil's rating. So Brazil's rating is BB minus. So Argentina is way below that. So we don't really look at Argentina, to tell you the truth.
Okay. So are you looking at Ukraine as well?
He's a fan of Telecom Argentina.
Yeah. So I was actually rather surprised, although for you probably it is rather reasonable comparison, but for me, well, I'm originally Ukrainian, and we recently had a webinar with Ukrainian investors saying about MetInvest. Do you have Ukraine in your portfolio?
No, that was just a comparison because it's very hard to find a company that has a mix similar to the one that we have for CSN in terms of mining and steel revenues. And the one that I find it to be the best fit is indeed MetInvest. So that's very
They're actually
unique.
very similar. True.
Yeah, they are very similar in terms of the controlling shareholder and its issues. We have similar ones for CSN and also MetInvest. So it's similar. Like there are some very interesting similarities. I guess at MetInvest they also have some coal mines, and there were some issues regarding the operations in the conflict zone. So this is a little bit different, but beside those differences, they are similar companies and trading with like similar yields. So nowadays it's hard to find yields at those levels. So that's why we compared both.
Okay. Well, speaking about the Brazilian markets, the Latin American markets, so as of now, maybe you have some thoughts on the potential defaults in high yield space occurring in Latin American markets. Do you think some issuers are not the best one for holding the positions right now?
Yeah, if we were to mention the ones that were most stressed here in the region, I would mention the airlines. So basically, the airline sector was the one that suffered the most. We've seen a few defaults coming into that sector. It was mostly LatAm. LatAm Airlines was a very significant one. Then we had Aeromexico and also Avianca in Colombia. Basically, we didn't have a lot of exposure to that sector. The only exposure that we had was Gol in Brazil. The Brazilian airlines, they are actually doing much better than the other ones. You have two names. You have Azul and Gol. They are mostly focused in the domestic flights, and domestic flights are recovering quite fast here in Brazil, even though we haven't seen the international flights coming back online. The domestic flights are coming back to the pre-COVID levels very fast. So basically, Gol and Azul are doing quite well. And the ones focused on international flights like Avianca, Aeromexico, and LatAm Airlines, they are struggling to come back to what they were doing before.
Okay.
So I think this is the most relevant sector nowadays that was suffering with defaults.
I have a question also to Marc. So could you kindly share your experiences? I believe you all guys actually had a lot of work this year, changing the positions in order to avoid all the risks, or sometimes you, since you invest in high yield, sometimes some positions could be in default or could drop down. So Marc, can you share your experience? What kind of positions you decided to avoid and not to recommend to your clients in Bank Vontobel?
I mean, I just would like to come back to your question in regards to Ukrainian debt, and there is actually one paper that I particularly like, which is MHP. Maybe the name is familiar to you. So they are in the agricultural business. And there is an interesting paper, which is a US dollar denominated one in 2024, which yields, I think, more than 6%. And, I think that's also quite a decent paper. And that's the way I play the Ukrainian markets. I think the firm is very well managed. So that's the name that I particularly like. and as well MetInvest. I mean, I do agree that it's also quite an interesting bond or an interesting issuer to play. So if we come back, to March and March events, I think it has been unprecedented. It has been much, I think, worse. The market conditions have been even worse than during, the crisis in 2009. Many of the bonds were not even in investment grade. Not even quoted. You couldn't even get a quote on, IG names, good quality names. So I think it was a moment where I have, some metrics and models that I do follow. So whenever, bond go into distress, all I do is I usually dig more into it and try to understand whether I have to reduce or cut exposure in order to avoid any potential defaults. But, in this particular market, I mean, I would say more than 40% of my bonds were into distress, spreads going above 1,000 basic points, and even much more very distressed situations on the 81, and also some pockets of the markets. I had, bonds dropping even more than 40 points in the space of a few weeks. So I think here what is very important, when you face a situation is to stay calm and to do your credit work, to do your due diligence, and really try to understand your exposure. And whenever you try to exit some positions, you have to have some type of convictions. And it's important not to let sentiment and also, I would say, market forces drive your action. And that's where I think as a portfolio manager, it's important to step back a little bit and even acquire bonds in those type of situations. And that's exactly what I did. I was very active, especially due to the lack of uncertainty, due to the lockdowns. I was very active in IG. So I bought tremendous numbers of bonds, which were offering some very juicy new issue spreads, when they were issuing new bonds. So I was very active on that. And I was also searching for distressed sellers. So meaning many individuals or investors which were just willing to drop bonds at any price, I was there to acquire. And I think one of the terrific weapon, and I think that's why I also understood by the two gentlemen in Brazil with their funds, is that they have the possibility to use leverage, right? If I understood correctly. And I have also something that is quite similar. So I can use leverage on my credit strategy. And this has helped tremendously because I could, from some decent names, I could really acquire some very good bonds. And by using leverage, when you are long only and you cannot you cannot differentiate yourself versus a beta product or ETF, that makes it quite difficult, I would say, right? But when you have those type of weapons at your hands and you can differentiate yourself, I think those are very good value added, and when you can definitely generate alpha.
The last question directly from me. Well, we had this question more or less more addressed to rating agency representative, but well, as you all already mentioned, today is a big day, and actually the market was anticipating, as some investors and some portfolio managers just decided to hold off in order not to buy something. So what are your outlook for the US results, and which positions you would consider if in two ways, whether Biden wins or in Trump wins?
That's a very good question. Lana, we've had a lot of questions from Brazil, so I've actually made some presentations to Brazilian investors about this subject. Basically, so you have the first talking about the two scenarios. In a Biden scenario, you likely have a weaker dollar. mainly because you'll have much more fiscal stimulus in the United States in that scenario, and lower growth, a bit lower over time, not at the beginning. It'll be higher, but over time it might be lower because of the higher taxes. So anyway, I think we'll have a weaker dollar in the Biden scenario, and this is generally good for emerging markets and good for commodity prices. So this is not a bad scenario for Brazil in the end. In terms of the global macro impact, there's a lot of talk about Biden saying that he's going to talk to Brazil about the Amazon, but I think that's a bit of a sideshow. I think the main impact is from a weaker dollar on commodity prices and the value of the dollar. So in a Trump scenario, I think we just give more of what we already had. Have a stronger dollar. We have continued unpredictable trade policy by Twitter, and this is continues to be a scenario where emerging markets will be a bit under pressure, I think, in a Trump scenario. Just in terms of what we think is going to happen, I have my most recent thoughts were about 65% chance that Biden will win, about a 30% chance that Trump would win, and a 5% chance that we get what I call a hurricane scenario, where nobody wins for a while and we're all held in limbo and the Supreme Court ends up having to intervene, and it's not a very nice scenario for financial markets. But a lot of people have talked about it and been worried about it. But I mean, I put only a 5% chance on that scenario. I don't think it's all that likely. Just to help people look at the results tonight, I think the main thing will be to look at whether Trump wins North Carolina and Florida, as he did in 2016. If he doesn't, then it's pretty much over. Trump doesn't really have much of a path to victory without North Carolina and Florida. And I think the markets will pretty much assume a blue wave scenario where Biden wins with a small majority in the Senate, which is a pretty decent scenario in terms of fiscal stimulus, and also in terms of not really having a strong majority in the Senate to get rid of the filibuster and go through with some more radical policies that the leftist wing of the Democratic Party wants to adopt. So if you get that scenario of Trump losing either Florida or North Carolina, I think that's pretty much the game over. If he wins Florida and North Carolina, obviously some of the Texas, I mean, he basically is winning all the early states on the East Coast that he won in 2016. Then it gets more complicated, because then the most important state is Pennsylvania, and Pennsylvania has millions of votes that can't be counted until today. They probably won't be able to get their results done for a couple days at least, if not more. And at some point there, you could have Trump trying to involve the Supreme Court, and the whole scenario gets complicated. So yeah, I would look at the Florida and North Carolina, and basically see what happens there.
Yeah, let's see what happens. And I really wish we won't see any black swans anymore, at least till the end of this year. I don't want any more. All right.
2020, so.
Oh, gentlemen, I really enjoyed this discussion. And in case you would like to check some investment ideas which were announced today, as you could see, all the presentations were done using our platform. So we can share all those links, so you can check them a bit later on. If you have a few ideas which topics you would like to be included into our next events, feel free to drop your comments or write me or Will personally, so we'll think over. I believe this particularly idea of arranging the webinar on high yield bonds and high yield sector was curious to listen to. Will, would you like to add something?
How thank all of the
enjoyed the discussion?
For a wonderful discussion. It was fascinating, and thank everybody who was part of the audience as well for taking the time out to join us today. So as Lana said, anyone has any questions, they're free to reach out to us. And of course, if you would like to test drive the Cbonds platform, if you're not already a subscriber, then you're more than welcome to test drive it. And Lana and I will be in touch with you in due course regarding this invitation.
Yeah, and now we launched our new YouTube channel for our English-speaking webinars. So feel free to subscribe in case you were not able to make it. We'll send you the record, or just subscribe to our YouTube channel just to be updated. All right, thank you very much for attending it, and wishing you a great day. Thank you. Have a good day. Bye.